Hi, I'm Vanessa Wieliczko, Chief Investment Officer at Hoyle Cohen, and I'm joined today by Steve Taddie, Chief Economist. We're going to talk about fixed income today and touch on interest rates, inflation, its impact on Fed action. We'll talk about the role of fixed income in the portfolio. We'll talk about the yield curve and as interest rates change, as the maturity of our bonds change. And we'll talk about spreads and the impact of credit risk on the income that an investor might expect in a portfolio. So Steve, with that, can you tell the audience how interest rates, inflation, and Fed action have changed over the past year?
Yeah, it's been an interesting, rather interesting year, 2 or 3 when you think about it. The U.S. economy recovered from COVID, and then inflation heated up post-COVID. The Fed began to tighten monetary policy to keep a lid on inflation, and year-over-year inflation peaked the summer of 2022 at about 9.1%. Now, as supply chains became more robust and reliable, the rate of change in price inflation began to slow. And as that slowing became more evident, the need for ever tightening monetary policy became more diminished. So the Federal Reserve was able to initially skip a rate increase, which became more of a pause that has lasted about 10 months. Now, monetary policy is not a game of instant gratification. With respect to economic activity that we see every day, there's a lot of time lags between policy action and impact, and you can only estimate the timing of that impact. Whereas in the bond market, there's a more instant impact on short-term interest rates, which affects bond investors. A component of the tighter policy that I was talking about, it was the increasing of the Fed funds rate. And when that happened, short-term rates across the board rose and longer-term rates edged up a little bit, but the major impact was on short-term rates. And as tighter policy ran its course and inflation expectations fell, the Fed paused the rate hikes. Now, overall, short-term interest rates seemed to top out, and longer-term interest rates continue to rise a little bit as the time value of money calculation crept back into the bond investor's mind, meaning earning a rate of return that accounted for, made up for the risk of tying your money up for multiple years in maturity. After an almost 10-month pause, interest rates have begun to hover in a fairly predictable trading range, and the discussion has turned to when the Fed will lower interest rates. And all of this has had an effect on the yield curve.
Okay, so starting with that conversation around yield curve, can you give just a 30,000-foot view of what the yield curve is and why it matters to bond investors?
Yeah, sure. The yield curve in its simplest view is that it's a view of the interest you're being paid for a specific maturity of a bond. And the curve is created when you connect all the dots from 1 year to 30 years. Now, the most common Treasury curve, the most common curve people talk about is the Treasury curve, but there are curves for corporate bonds, municipal bonds, et cetera, et cetera.
Okay, so we talked a little bit about the economic and policy buildup. How did the past year affect the bond market?
Well, to talk about the past year, probably need to look at a graph or a chart that'll show where the yield curve was and where the yield curve is. Okay, so thanks for pulling up that chart. So you can see where on the chart we have 2 years ago, and it shows the curve being normal with yields dropping for the short term. So you're getting paid more to lock up maturity than you are for, say, money market rates of return. Now, through the course of the recovery from COVID, when the Fed was fighting inflation, the short-term interest rates rose. And they went quickly through a flat yield curve where short-term interest rates are the same as long-term interest rates, the whole way up to an inverted curve where short-term rates are higher than longer-term rates. Now, as that happened, investors who had been in longer-term bonds crowded into the short end of the yield curve because they were making more money on the short-term bonds. Those that had held longer-term bonds during this upheaval in interest rates, they lost principal value on their bonds because the coupon rate they had bargained for, a 3% coupon on a 10-year bond that they bought 2 years ago, doesn't compare very well when you can buy a 4.5% coupon bond today. So what the market does is it takes a chunk out of the value of that bond and makes the yield to maturity of that bond equal what's available in the new issue market today. So that's where you get that temporary decline in principal value, knowing in the end that the bond matures at par value and the rate of return is what you bargained for, but in the interim, that price goes down. For those that stayed short term and didn't experience the price decline on their longer term bonds, they experienced higher income rates. And they fared pretty well in what was one of the worst bond markets of our time. An easy way to view bond prices and interest rates is when you view a seesaw on the playground. Interest rates on one end, bond prices on the other, and as interest rates go down, bond prices go up, and vice versa. Interest rates up, bond prices down. So we find ourselves as bond investors at the mercy of the current yield curve. And you can see investors are being paid more for interest in the shorter term maturity bonds now. And that's why many investors have parked money there.
Okay, so that is an irregular, that is not a normal occurrence, right? That's not a normal yield curve.
Right, that is called an inverted yield curve. And they don't happen all that frequently, but we do know what happens next.
Okay, so what happens when the Fed funds rate comes down? What happens to the bond market?
Well, let's take a look at the next chart. So I've used the same chart as the first one, and I've just superimposed a red line on it, which is the shape of what the yield curve could look like a year from now. And if you take a look at the curve, shorter term rates have dropped. So what that means for investors that have piled into the short-term bonds is they're going to be receiving less interest income as they roll those maturing bonds, CDs, treasuries over. That's going to end up pushing investors out of the short end of the curve and into longer maturities or other securities offering higher yield than the shortest of short bonds.
Okay, we talk about the role of fixed income in a portfolio. Certainly, there are situations where a client may have some known expenses in the short term, and therefore it makes sense to stay in short duration fixed income.
Right.
However, in many cases, the role of fixed income is as a diversifier to a portfolio, as an income producer. And so we have a long-term time horizon and can really position ourselves in fixed income at a duration that we think is most attractive. So is there a sweet spot in our expectation of how this yield curve may change, where interest rates may go from here?
That's a great question because we think that there is a sweet spot and it exists right in this 5 to 10 year maturity on the treasury curve. And remember I said that the curves, there are curves for corporate bonds, curves for municipal bonds, et cetera. In this particular curve here, we get to do what is called riding the yield curve. It's an old bond trader's term. And that just means that we buy or we lock in a coupon rate, say on a 10-year bond. Now, every year that that bond gets closer to maturity, it becomes a 9-year bond, an 8-year bond, a 6-year bond, and it begins to compete then with newer issues that would be offering a coupon rate lower than the coupon rate you locked in a couple years back. So that bond ends up getting priced at a premium to
With
par
the
value.
seesaw effect,
What,
right?
what's that?
With the seesaw effect that you mentioned.
Exactly. And we know that the bond's going to mature at par, right? So you take advantage of that increase in value of the bond because the shorter term interest rates are lower. And then you take those proceeds and invest them back out on the longer end of the yield curve to lock in yet again another higher interest rate on the bond. And as long as the yield curve is normalized like this, you can do that all day long and twice on Sundays.
Okay, great. Well, can we talk a little bit about the bond market in the sense of municipal bonds, corporate bonds, and how the yield curve may differ in those areas?
Yes, yes. And there's these yield curves are different because and the interest rates are different. And the difference between these bond yields is called the spread. Now, the chart you're seeing right now in front of you shows the difference in yields between US Treasuries
Mhm.
and investment grade corporate bonds. That difference is pictured above on the spread history of US Treasuries to corporates. And you can see that the difference in the yields is a bit below average. But that said, the difference between a 5.68% corporate bond and a 4.35% treasury bond is a little over 1.25%. What that means to the investor is every 4 years, they get an extra year's worth of interest compared to what they would have earned in the US Treasury market. And that doesn't come without risk because the US Treasury market is backed by principal payments, interest payments guaranteed by the US government. Corporate bonds, on the other hand, the payment of principal and interest is based on the credit quality of the issuer. There are credit qualities of AA, single A, the whole way down to triple C. Municipal bonds have the same credit rating scheme, so to speak. And as you might imagine, the higher the credit quality bond, whether it be a corporate or a municipal, the less interest income they typically pay for the bond investor.
Additionally, I mean, I know that spread is impacted by multiple factors.
Yeah.
However, typically you're going to get a wider spread when there's more uncertainty in the economic environment. So, can you speak to how the assessment of market participants regarding the economy, corporate fundamentals, and health may come into play here?
That's a great question because our view of the economy is that it's quite healthy and that it's being driven by the strength of the employed consumer. As inflation rates fall, the wage increases that you've read about in all the newspapers, they become real wage gains, meaning a gain above the inflation rate. So it bolsters the consumer's net worth. And we are a consumption-based economy. Roughly 70% of our economy is consumption-based, service-based. So our view of the economy is that it is quite healthy. And yes, the Federal Reserve is raising rates or has been raising rates. Let's make that clarification. And whenever you hear Fed officials speak, and especially Powell, he's talking about not seeing the need to crush the economy to get inflation under control. He wants to play the long game with the economy, which means a game of gradualism, long and variable impacts between monetary policy and economic activity. And they do not seem willing to push it too far. Hence the 10-month pause in the interest rate hike scheme, which might easily last 12 to 15 months. So we don't have the fear that exists in other economic cycles that a AA or single A rated bond or a triple B rated bond is on the verge of bankruptcy and that one's
Right.
investment in their bonds is bad.
Well, thank you, Steve, for your time today. I appreciate the conversation. If you heard something today that might have piqued your interest or you have additional questions, don't hesitate to reach out to your Hoyle Cohen advisor, and they would be happy to drill deeper. Otherwise, if you don't have an advisor, please reach out to us and we'd be happy to connect you with one.